I'm Keith McCullough. Welcome back to day 2 of the Investing Summit. It's always my pleasure to have Liz Ann Sonders, one of the best people in the business, one of the easiest people to talk to. She's data-driven. She's as diligent as you're going to get. We were talking quickly before we got on. I have a data pack here from Liz Ann, which she didn't know that I had because it's my team that aggregated all her content. It's as thick as it's ever been. She's doing more work than she's ever done. And it's great to see. I know that the people that are on, in particular on the Twitter channel, are quite thankful for all that you bring to the table every single day. There's a rhythm to it, isn't there?
Thank you. There is, and it's funny. And you and I touched on this just before going on camera. I remember at the outset of work from home, how many times I would hear from people who were more skeptical about how people would do it. And the thing I constantly heard was, I just worry employees will become slackers. And I thought to myself, I don't know, I think you're either a slacker or you're not. And for many people, eliminating, say, a 3-hour commute round trip, I'm not sure how an environment where people were commuting a long period of time to go to work were then much more productive in the office. I think it's mindset. You either are somebody that really enjoys what you do and want to work hard at it, or you're not. And I'm not sure the physical location matters all that much.
Yeah, and at this stage of the game too. I mean, I also tweeted that I love Liz Ann from Florida because she's got a lot more Liz Ann time to do that. I mean, it's tough, at certain parts of your life where you're grinding it out on the lacrosse fields, getting the kids everywhere you need to go, and now you're in a happier place, not because of the kids part, obviously, but because it's just it's a good way to do your work.
It is, and I do miss the interaction, the in-person interaction, certainly with investors and our clients. I can't say I miss the physical aspects of the travel. So I think whatever the post-pandemic norm looks like, my guess is it will be a bit of a hybrid relative to how we all used to work historically. I think to some degree the genie is out of the bottle in terms of how we can be efficient and use technology in certain ways that we never did before.
Yeah, I think it's great. I mean, in particular for people that are consuming content the way that you and I are producing it. Again, you're part of what I think is if you have a curated stream of content providers, which is effectively what it is, you can get really smart about what's going on in markets relative to what you might have been beholden to before, which is not a lot of awareness, certainly not any timely topical data. So on that, I want to just jump right in. I mean, I did this the other day, and I don't know if you saw it or not, but I basically took, because there's also a frustration to the Twitter channel, which is the unawareness, or as I would affectionately call it, the macro tourism to it all. And we have a lot of interacting agents. I'm pretty excited about all the hoodies and the new participants, but that doesn't mean that they're fundamentally aware of everything that's going on. And what I think's happened on Twitter and in the market broadly is that people have been much more susceptible to coming up with narratives. No numbers, just narratives, because that's what human beings want to hear. They want to hear a story. So the other day, when stocks were at their highs, I just kind of wrote this note that said, why are stocks higher? And I picked the top 6 things that were in what I would call old wall media. And I just want to get you to tell me if any or all of these things are the reasons why stocks go up or only go up. This one, actually, I heard you talking about the other day, and this is a good topic, and not everybody understands the words in this one, but a boost from the momentum growth trade due to underperforming value recently.
Oh, so you're asking me to opine on that. So yeah. The whole growth versus value differential, I think, is largely misunderstood and often expressed in really, really simplistic terms. I actually think what's going on in the market, particularly since beginning of September, where we've seen these bouts of rotation, is less about growth shifting to value, but a bit more nuanced than that. First of all, growth and value, there's a big difference between the factors or characteristics of growth and value and the index labeling of growth and value. And one example of that I often use is if you go back to October of 2002, after the tech bust, the market finally bottomed. S&P had been down 57%. NASDAQ and NASDAQ 100 were down between 78 and 83%. So you finally bottomed out. Using the S&P growth and value indexes, the technology stocks in the growth index back then had a PE of 20. The technology stocks in the value index had a PE of more than 25. If you were a value factor-oriented investor, where you found value was in many of the tech stocks. They weren't suddenly housed in the value indexes. They were still housed in the growth indexes, but that's where you went to find the factor of value. So I think we get lost in this simplistic growth versus value without understanding the nuances. We're in an environment of very suppressed overall economic growth, obviously right now, but really in the last couple of cycles. And we have a shrinking share of companies that are actually displaying things like, trailing 5-year sales growth or revenue growth of more than 15%. On that metric alone, there were 220 stocks in the S&P in 2000 that met that criteria. There's only 60 stocks now that meet that criteria. So there is a growth constraint right now, which is pushing people into companies that have those growth characteristics. But that same analysis can be applied even in those value-oriented sectors that are in the value indexes. You can still use that factor to do well as an investor. So I just think and it happens in places like Twitter where you're limited to characters. There's these simplistic narratives that really deserve a bit more explanation than is often provided.
That's exactly why I wanted you to knock down every single one of these 6 pins. They'll get less complex.
All right, what's the next one?
But first, I just want to make sure everybody knows entirely what you just said. Guys, go to slide 4. Like the game that we're in is not the game that a value versus a growth manager used to play. I mean, let's just start with that. So we're showing here, global assets under management in the hedge fund community against what's actually in ETFs and ETPs in terms of asset management. As you know, this game has changed dramatically. This is why Schwab's had so much success with people, really actually having a macro point of view, because you can express, there are 100, at least in my model, there are 174 different ETFs that you could express, whether they be factor-based exposures, outright macro positions, currencies, commodities, fully loaded. So this is the game that we're in, Lizanne. Whereas a lot of people simplistically are still talking about the game that used to be. You're either value manager, growth manager, blah, 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 blah. And of course, the value managers have been completely eviscerated if they were long the financials. Just calling value for what it's become, which is a lot of stocks trading at what you would characteristically say, well, that's a value stock. It's trading below book or 1 times book, something like that. But
even among the value indexes, S&P value, Russell 1000 value, Russell 2000 value, to your point about the weight in financials, there's a pretty big difference in how much financials represent in those all value indexes, which means if the financials are taking a particular drubbing, you're going to see a big spread in performance even among the value indexes.
Yeah, I mean the Russell 2000, the biggest weight is the financials. I mean, so therefore the weight on
almost
the performance
40%.
of the Russell, right? So that's an important one. I mean, it was kind of interesting that headline was tied to COVID cases are rising, therefore tech should accelerate, and that's actually accurate if you look at it from a quad perspective. You're familiar with my quads. In quad 3, what works? Inflation, commodities work. Gold works big time because you have real stagflation, real yields are falling. And tech really works because it replaces the cyclical growth that you thought that was going to recover into a V, but it wasn't a V, therefore tech worked. So it's kind of like this perverse headline like, really? Stocks are going to go to all-time highs because COVID just accelerated? Now that's an interesting one. What do you think about that? The COVID acceleration is why stocks are going up.
Well, so stocks are largely going up, with the exception of about in September, where the largest 5 stocks in the S&P lost some ground relative to the bottom 495. Absent that 3-week period or so, since February 19th, the largest 5 stocks are up about 33%. The other 495 stocks are down slightly.
Yeah.
So because of their power in the index, they represent 25%, almost their own quartile on a cap-weighted basis. Their strength can lift the overall market. But the reality is an environment where a very small handful of companies are not just surviving but thriving, but the vast majority are not, is to some degree reflective of the COVID world. So the question I get all the time is, isn't the market completely disconnected from the economy? On the surface, yes, but you don't have to peel back the onion very far to see that this narrowness may be indicative of what I think is an appropriate sort of letter, kind of this K-shaped recovery where you've got a small subset of winners and a heck of a lot of pain still within the economy and under the surface of the averages.
Yeah, and the K isn't like capital K and Keith McCullough. I mean, it's like a dysfunctional nonlinear K. I mean, you have way more people on the bottom part of the K than you have in the other part of the K. Right. So it's like, again, you got to be careful with these like simplicities and narratives. But on that, like you've written about this a lot, and this isn't. I knew this was going to happen. I wouldn't hit all 6 pins down with you because I'd have some follow-on questions. But you end up in a place where people have the bubble or not discussion, and a lot of people will say, well, it's not a bubble because the multiple's different, and you just address the multiple. But bubble and market cap, this is unrivaled by any historical measure. There's nothing that the world's ever seen anything like it. Guys, show slide 75. The global economy is not 6 companies, but this is like a chart that's pretty crazy. I think when I look at it, that's why we made it this way, because it's against big things like the DAX or the FTSE. I mean, whether you can see this, right? Apple and Amazon, and then if you want to go for all 5, it's like, to me that is a bubble. Now, if it wasn't a bubble, it wouldn't keep going up. And I just want to kind of get your response on that. Does it have to be a valuation bubble to have an asset price bubble?
Well, I actually don't know. And I generally hesitate using the term bubble, only because I think it's used a bit too frequently for anything that's going up a lot. And maybe it's just semantics, but I think I tend to use, speculative froth, and maybe it's one and the same. But to your point, yes, at 25% of the S&P on a cap-weighted basis, that's well above what the largest 5 back in 2000 represented, which was 18% that time. Of course, it was a different 5 companies, with the exception of Microsoft. That's the one that lasted in that top 5 over the 20-year period of time. The only caveat from a valuation perspective is, and it's a sign of better underlying fundamentals of these names. And Keith, as you know, I don't cover any individual stock. I'm not an advocate for these 5 companies from a stock picking perspective. I'm taking more of a macro approach. But if you looked at the largest 5 companies back in 2000, their average PE was 60 on a forward basis, versus now it's about 32. Now 32 is not cheap by any means, but that is the differential that I think is an important caveat in order to not stop the conversation at, well, now they represent their own quartile and it was only 18% back in 2000. And that there are stronger underlying fundamentals of this small subset of companies. And that is somewhat specific to COVID. You think about, again, not an advocate for these names, but you think about, especially in the worst part of the pandemic when we were all basically locked down, how much time we all spent and still do in the ecosystem of most of those companies. And so, I'm not suggesting they're a buy here. I think rotation continues to be sort of necessary to ease some of this speculative froth, but it's not quite the same extreme as 2000. And I'm sure we're going to touch on it. I think there's other differences between now and 2000 with regard to speculation, which we can talk about if we get on that subject.
Yeah, there are many differences. It's always different. It's never the same. I mean, it's 2020. It's not 2000. I mean, people just need to get comfortable with the fact that, again, going back to the ultimate point I'm trying to make, is that if you're narrative based and you have to tie everything back to what happened in 2000 to bubble or not bubble, whether you define it through valuation or through market cap or not, you're still losing the point of where we are today. Like today, guys, show slide 77 to Liz Ann's point. Like just get down to the screws on fundamentals. I mean, you look at the revenue growth, not just like to what you just said, like during COVID. So I'm showing a CAGR for basically the mega cap revenue growth on this year, but also going back to 2019. So again, it's been this story the whole time that and this is kind of the key point. The U.S. economic cycle peaked at the end of 2018. You didn't have to have COVID to have the slowdown. It just triggered a faster slowdown. So this is the world that you have. And,
That's right.
And from an asset allocation perspective, it really is a macro thing. It's not about picking 5 stocks. It's about saying, okay, what is the sustainability of that revenue growth rate? I believe that the stocks earn their market cap because both the relative and absolute growth rates earn that, and the losers earn their loser status because they were losers. If you're a loser, like you don't teach your kids to be. If you lose, you lose. That to me, that's what happened. But it doesn't mean it's perpetually going to happen from here.
And I agree with you that COVID, in many cases, both in terms of what's gone on inside the stock market, but also more broadly in the economy, brought a lot of new things with which we're all dealing for the first time, but really accelerated many what were probably secular shifts already underway. And I think that's maybe the more important thing to think about long term is what were these secular shifts that were already underway that have been sped up, and how does it change the economic landscape looking ahead?
Yeah, I mean, again, I called it Hedgeye risk management for a reason. This is now a risk. If you don't like it, then too bad. It is what it is. It's got huge factor exposures in most portfolios. The third point on why stocks were up: earnings to beat expectations. What do you think about
that? That's a silly one. Look, I believe that when it comes to the relationship between the stock market and either earnings or economic data, that, and I've said this to you many times, better or worse does tend to matter more than good or bad. But in this unique environment, if that is sort of the pure narrative, it misses the fact that a record number of companies withdrew guidance heading into the second quarter, and analysts were flying way more blind than they ever have. And the reason why companies had to withdraw guidance is not to be stingy with their information. We were all flying blind. We had no idea what this thing was going to look like. And I think what analysts did in the second quarter, and maybe even the third quarter, is absent that more precise guidance, they erred on the side of slashing estimates more than ultimately they probably should have. So the bar got set incredibly low, and you exceeded expectations. But here's an instance, not just with earnings data, but with the economic data, because coming off the shutdown, economic data, it's the nature of small numbers, the initial percentage increases, whether it was week over week, month over month, looked huge. That's the way the math works. Yeah. But in this unique period of time, we have to be also mindful of level, and not just mindful of either rate of change or relative to expectations. I think we have to put level back into the mix.
Yeah, because the level of again, earnings growth, if it's a negative number, is deleveraging for everything that you would do if you had positive, on a year-over-year basis profits. So there's a lot like that, and the financials are interesting because they've already started. I mean, you could have woke up like rainbows and puppy dogs and go, oh, look at Jamie Dimon, it's better than expected. The guy understated loan loss reserves like epically. And then Citigroup tried to do the same, and then Bank of America pukes this morning. And it's like, okay, game on, earnings season. Earnings season to me was actually a negative catalyst. So that headline to me, like I said, it's kind of silly.
Well, and their macro message, the bank head's macro message was not terribly positive. It was, look, this is going to be a grind, and there was some mention of absence of fiscal relief, at least near term. And so I actually think, much as I was saying when we were getting second quarter earnings reports, I continue to think the macro message that is coming from companies in the commentary they put out with earnings is probably more important than the micro message of, was the beat rate 85% or 80% or 87%.
Well, that's like, I feel like when I watch Twitter, like on the narratives, I feel like I'm watching people play the game from like the 1990s. I mean, when there was like no internet. I mean, it was kind of thoughtful to talk that way then because it was information other people didn't have. But now, like, I mean, really? Like, that's actually not what's causing the daily moves. If all you were to get right is the dollar on a daily basis, you'd be more happy with that, for example. I'll get to that one in a second. But how about on the, and this is what a real big question of ours on slide 46, the permanence of labor loss. And that's something that the banks, either do or do not recognize through the lens of loan loss reserves and credit risk. But like, we think permanent unemployment could double from here. I mean, that, to me, I don't know how you get to any letter of the alphabet that you would be familiar with if you have that view. Now, again, this is my view, so I don't expect you to agree with it. But I mean, what is it about the permanence of labor loss that does make it different in 2020?
Well, so I've gotten recently in the past couple of weeks, done events like this or spoken to the media, and a common question I've been getting is what is the economic data point or pair or set of points that you're paying most close attention to? Mm-hmm. And it's permanent unemployment related to temporary unemployment, which of course temporary unemployment has been coming down, and that's largely because the payroll gains we've seen since the April pandemic low have largely been people being brought back to their prior jobs. So temporary unemployment has gone way down, but permanent unemployment is going up. And in addition, the unemployment rate has come down, but long-term unemployment has been going up. And those become powerful in a negative way forces that, they're maybe a little bit different this time, because the problem with if long-term unemployment is you become less employable, there's often a stigma associated with that. Maybe that stigma is a bit less in this unique pandemic environment. I'm not sure prospective employers might hold against somebody if they were a bartender that they've been out of work for a year. So maybe it's marginally different, but there is still a really difficult impact on the economy, on animal spirits, on the psyche of the workforce when you're looking at really high levels of long-term unemployment and permanent job losses moving up, even as temporary job losses go down. So those are the labor market metrics that I think are most relevant to keep an eye on.
I think that one, and I wasn't looking for you to agree with me on it, but I don't know how you couldn't have that in your top three things. That's far more important than some narrative on whether something beat or miss, or whether you think it's this letter of the alphabet or that. I mean, this is where the real screws of the economy are. And I wonder, like the fourth pin on my sheet in terms of why stocks are up is that don't worry about that, because a blue wave of stimulus packages are pending. So that's just going to replace it all. I mean, is that enough? Because I used to hear that blue wave was a bad thing.
I think the stimulus narrative is the one that if you were going to say, here's the narrative that's been driving the market since March, I think that's the one. I'd put that at the top of my list. But I would make it the combination on the monetary side and the fiscal side. And it also early on sort of showed the power, right or wrong, of the Fed's words, because right around the point, it might have been the actual point of the March 23rd low, came the announcement by the Fed of the new tools they were pulling out of their toolbox specific to this pandemic and being a backstop on the lending front for businesses moving into the purchases of corporate bonds and high yield bonds and ETFs. And that was enough to bring spreads down before those actual facilities were even up and operable. Yeah. And then you tie that to, of course, what was done on the fiscal side, which combined, absent the current package that's being discussed right now, more than 40% of GDP, and M2 money supply jumped by 25% year over year. In a closed economy, that money had to go somewhere, and it went into asset markets. So I think that's the narrative. And right now, to your point, I think the fiscal relief narrative, yes, is still the one driving. Even if we don't get it in the election, given what polls are saying, given what the betting markets are saying, Biden's going to win. Priority number one will be an even bigger fiscal package than what's being negotiated right now. All good for the market. Now, that is the easiest narrative you don't have to know anything about anything, and you can be right for a period of time on that something. And there's also a probability, not a small one, that you don't get that. I remember this period called October of 2008 when everybody was going to get this gigantic TARP package. Buffett was in, everybody was in. Hank the Market Tank, Paulson, the Bernanke, they're all ready to go. And then nothingness. And that was, that was the beginning of the real end for people that were buying, anything really in the equity market. So I wonder if it took massive pain in stocks in order to sort of finally light that fire to ultimately get TARP passed. And I certainly hope we don't have to see that in this environment. No. I do think some form of fiscal relief is necessary, as much for the small business side of this thing. When we're going back to what we were talking about with permanent job losses, clearly a leading indicator of that is bankruptcies, which are up beyond levels that we saw in 2009. Oh, yeah. So the leading indicators for a continuation of this ugliness and permanent job losses don't look great. And if you just want to write somebody a check, that's not cash flow, that's just cash.
The impairment of one's, the loss of one's job, the permanence of that, or the ending of one's small business are tragic. These things just don't come back like whatever they call them, green shoots on CNBC. Slide 48, by the way, just on that point, to her point, she nails every frigging point. It's so easy to get her to go and knock down these pins. But 50% of total employment and 80% of employment growth is from small businesses. This has been represented only in the PPP, but I mean, that's not really the stimulus package that they're arguing about. And again, no matter what your political opinion is on what the dollars should do and go towards, that's the other big surprise. And I wonder about that. I mean, Wall Street has had its cake as is usually the case and been able to eat it too, and that their stimulus went to like you said, like the junk bonds. You didn't have to buy them, and then eventually they bought them. But the fact of the matter is that we didn't do an MMT style printing of the money and allocating of money to people to be able to eat a meal, clothe their kids and have a roof over their head. That we've decided that that's not the priority. So what happens if you have a stimulus that it actually makes the blue wave makes that a priority? It doesn't make buying junk bonds and making private equity rich a priority. Am I right about that or what?
Yeah, well, what I'm concerned about is, look, if we have within our sights a combination of caseload going down, therapeutics working even better, a vaccine that is actually effective and available, all of those factors such that a year from now or whatever it is, we can really look back and say, okay, the worst is over, we can kind of get back to normal. Then I think that the bridge that both monetary liquidity and fiscal relief, notice I'm not using stimulus, can continue to sort of build that bridge across this chasm that was created by this virus. What I worry about, though, is that even in a whatever we term a post-COVID environment, a lot of the world has changed, and there are certain businesses right now, and industries, I should say, and businesses within those industries that are really facing existential threats to their ability to survive. We're witnessing massive kind of creative destruction right now, and there's creativity we're already seeing and we'll continue to see, but the destruction is happening now. And that's one of the big differences between what's been provided in this environment, both on the monetary and the fiscal side, and what was provided largely on the monetary side coming out of the financial crisis, is once we solved the problem within the financial system, companies were able to kind of get back on their feet, because there were not whole swaths of industries that were facing these existential threats to their ability to survive. That's what's different this time. And as a result, I think the concern that Fed policy is going to allow, zombies to just hang on ad infinitum, I think the realistic assessment of the ability to survive from the business's perspective is different than what it was, say, in 2009 and 2010.
That's a critical point. And most people that want to use, as we would say, a secant line and just draw a line from the bottom back to where you were in the prior top with the same mix of ingredients and same economy, that's bananas. That you would have to only have a one-factor model, which is a blue wave of stimulus, to assume that. I mean, there's going to be so many different ways to make and lose money on the other side of this. And by the way, I do think, like our model would say, it's easily quad 2 by Q2 of next year, and maybe even in parts of Q1, because you're comparing against a disaster. But that disaster doesn't just bring everyone back. Like you said, the zombies didn't come back. You nailed number 5 on the pins, by the way, which is the vaccine optimism. Now, that's the 5th reason why stocks are up. I can't kind of circle the square when I have vaccine optimism is why we're up, but we're going to get a stimulus because we don't have it, so we're down. Like, those two don't go together. I don't know if we have to talk about vaccine, but the sixth one. This is the most.
Well, it's not the elixir the day it's announced as one being available for all that ails us. It's just not. The history of vaccines and efficacy and availability and who gets it first and does it have to be administered a second time? I mean, there are a gazillion questions that follow the headline to which we don't have answers.
And there's this thing called time and space. And that's my big problem here, is that right now, the volatility of the market is not giving you time and space, hence why we need, or a lot of people think we need, a stimulus now. When the VIX is trading at 26 and could go to 36 in a day, or NASDAQ volatility, which is more important given the concentration of the NASDAQ, is trading at 34 vol or 34 volatility, the market doesn't have time to get to these bridges. Right. And that's the most important thing that I think I see, typically when I see a quad 4 pending, which is, disinflationary pressures. When shit hits the fan, everything goes down at the point in time when everybody is gross long levered the same stuff. And that, to me, is the biggest risk. I know that that's not in the top 6 things on why stocks go up, but it certainly was the number one thing that made a lot of stocks go down, to your point, in September. It was a 13% drawdown in 3 weeks in the NASDAQ. That doesn't just randomly happen.
That's right. And it was the only month in which those largest 5 stocks went into, beyond correction territory.
Right.
And the other 495 actually stayed relatively flat. That was a very short-lived period of time, but you did see that reversal in the dominance of the large 5.
Yeah, it's the short period of time. Last I checked, if you're about to succumb to an avalanche, you're at the bottom of the hill and you didn't listen to the risks. It's a very short period of time that you have there to say your prayers, I suppose. There's that's how I think about risk management. It's a very different way than this linear valuation. The cycle's going to be here at this period of time view. That's just not how I roll.
Keith, you mentioned a couple times short period of time. One thing I think that makes this cycle different is how condensed it's been in time, and the sort of peak to trough extreme bear market phase from February 19th to March 23rd was so short-lived in time. We have to remember that bear markets have an impact on the psyche of investors, both in price and time. And that's the big difference between this most recent bear market and what happened between October of 2007 and March of 2009 is the percentage drop was a little bit more, but down 34%, which we got this time, was extreme. But it was such a condensed period of time, and we got that sharp rebound that we didn't have that time factor weighing on sentiment like is often the case with other bear markets.
Yeah, that again, if you study history, which you obviously do, you can see that there are these things called workout periods. And that's actually what the whole point about the labor cycle is, that you have your labor shock, and then there's time and space that has to occur before you work out of that. Same thing with any C&I loan lending cycle, any credit cycle. And it's just not going to happen on your clock in this very short window that you'd prefer, because that's just not the way that the cycle works. I've always thought that the Fed is going to fail in banning economic gravity. I know I'm probably in the minority at this point, but we'll have to see. With time and space, you tend to see that the cycle just won't seemingly go away.
Yeah, I agree.
Last one, which is, and then we'll take some questions. Now, this one I agree with. Just again, there are plenty of things that I agree with here. The blue wave thing, not so much. That's a hedge fund I used to work at that blew up. But it's also the name, and was named by two of my
Darien
bosses.
High School, where my kids went.
Bingo.
Darien High School Blue Wave.
So when I hear blue wave,
that was the odd mascot.
Yeah, what I thought I saw with the bank stocks yesterday and today with Bank of America is more like a red wave. So we'll have to see about that. And all the people that work at these great banks, phenomenal, tremendous jobs, I guess. You're going to have higher taxes. Remember, you're the people that earn $400,000 or more. You're the big timers. So yeah, it may not be the nicest blue. It may be a little red or dirty, is what I thought about that. But dollar weakness. Now, dollar weakness, I have triggered people from Bitcoin to cattle ranchers, not as much cattle ranchers on Twitter, but, and back again. They go bananas whenever I say it's all about the dollar. And what I mean by it is the immediate term correlation that the market's built up with these expectations. In other words, you want stimulus, the most in the history of America, you want to devalue the dollar? Well, we'll trade assets in those dollars. And when the dollar has up days, you have days like yesterday. And to me, it's the most obvious risk. What do you think about that in the short term versus the long term? A lot of people in the short term say, hey, look, I'm not a short term person. Long term, okay, I see your point.
So I agree with your point broadly, but here again is an instance where I think we have to provide some nuance, because the weakness in the dollar recently has not been consistent across other currencies, of course. So I think there has to be, and I'm not a currency expert, so I should say that up front as a very important caveat. I often do that when I talk about options. It's like you can fit it in a thimble, what I know, with room left over. But I think there has to be more pair analysis specific to the impact on certain industries and certain companies in terms of where they're conducting business, especially in this COVID world, the vast differences in economic performance from region to region, or I should say currency to currency. So I think, the weaker dollar provides, the narrative provides support for export-oriented earnings, but I think there's more work that has to be done from a pairing perspective.
Yeah, I agree with that 100%. I mean, the dollar looks very strong versus Turkish lira, Brazilian real. I mean, it's starting to look stronger and stronger against the euro. That's really not like the point.
Even just the difference between, say, the DXY and the Bloomberg Trade Weighted Dollar Index because of the differential in how they're weighted.
Yeah. Now, when it comes to correlations, guys, pop the table up that I look at before I go to bed at night. My life's really exciting. This is it's just numbers. I'm not reading somebody's report. I don't care about other people's words on this. They're all red and getting redder. And at the bottom, I even have Bitcoin there just for my new fans on that front. Again, these are massive correlations. And what that's saying, Lizanne, as you well know, is that if you devalue the dollar, if you give me my stimulus, both Fed and fiscal, I will price the things that that trade in dollars higher. It's not that complicated.
Higher.
I don't know why people struggle with that, but it's not good actually for the people, is it? Now, if you're, you can't eat a Bitcoin, but you can definitely, eat a cow. You can eat like all the different things. We've seen a massive breakout in ag. Corn's testing $4 a bushel, or at least close to it. What do you think about that? Is that too much of me trying to say, well, Wall Street got paid, but the people are going to pay the bill?
Well, I do think it's negative long term for Americans, for the economy. But to your point about the correlations, that doesn't mean it's not going to be short term positive for certain indexes and certain commodities that are priced in dollars. There's no question about that. So I'm with you on that one.
And longer term, I guess this is the other point. You can't get away from this either when you think about bubble or not, market cap or valuation. The guys show slide 88. I think a lot of people that are narrative-based may not even know this. This is kind of like you got to know where the dollar's been historically. And it's like this twin peak, where there was nothing else you could have invested in 2000 other than U.S. large cap tech. Have you heard that before? You couldn't buy EM, commodities. There was no Bitcoin, but you couldn't. This is at a very interesting point for central planners to go to MMT and potentially devalue it. This gets me excited, Lizanne, of course, because there's no such thing as people that are commodity bulls, for example, right now. Certainly not energy stocks. I mean, if they are, they're more like somewhere in a tent. They're not running money for real. But these are the places that people are really bearish, where you would find deep value.
Yeah, and I think, on the commodity front, in addition to the currency impact, we also have too much of a connection being made between the increase we're seeing in certain commodity prices and broader inflation. A lot of the increase in commodity prices and certain commodity prices has come as a result of COVID and the massive supply disruptions, more so than indicative of 70s style systemic inflation. Well,
you get two things. You get the dollar down. The two biggest things that matter in commodities are supply shocks and what the dollar's doing. It rarely, and ironically, doesn't have to do with demand first. So again, that's another narrative that people would say, well, I went to Yale, I got this curve, and when this goes up, this goes down. I mean, it's like if you're going to do that, I have a lot of people with higher SAT scores for me that Yale have lower market scores trying to trade markets that way. But let's go to the questions. And thanks you for actually, we're going to go to number 2 first because Rodrigo's from Florida, and that's the Lizanne zone now. Lizanne, have you recently upped your tactical asset allocation models towards? This is a value or growth. This thing gets airtime, man. A value or growth, or are you waiting for a different signal? Have you raised your cash target as we head towards the election? Would a second Trump surprise be a factor in how you see the year ending? There's like 3 questions in there.
All right. Well, the growth and value thing, to some degree, I provided the details of the answer that I'll give now. Is we make tactical recommendations on the overall broad asset classes like US equities. We make tactical recommendations on, from a cap perspective, large versus small. We don't on growth versus value for the precise reasons that we discussed earlier. There's a big difference between the factors of growth and value in the index labels. So to just say, continue to overweight growth, well, what does that mean? Or we think there's going to be a shift to value. Does that mean you just index to the value indexes? I think the factors that will continue to work, and this is what we express in our views that are outside of these precise tactical models, is we think you want to continue to look for companies that can grow their earnings in a still challenged environment, but not do it by taking on excessive amounts of debt. So that balance sheet quality in particular, but also have a bit of a valuation mindset when, say, screening for growth and quality characteristics. So that's a bit of a blend, but it's just too cookie cutter to say overweight growth or overweight value, and that's why we don't do it.
That's a great answer, and more people should hear it. You guys, throw up the factor exposure table so people can look at what quality means. You can look at this on levered versus unlevered. There's a lot of different ways. Not a lot. I mean, they're pretty straightforward. Quality is quality. So again, this is how modern risk managers and modern strategists should be talking, not growth versus value. How about on the question that he had with regards to the election risk and cash? Do you have that view or not, that you should raise cash ahead of the election?
Well, so that's a binary situation. And maybe it wasn't asked purely as an all or nothing, but I get it all the time. Should I just take my money out of the market now in advance of the election, let the volatility subside, and then put my money back in? It's similar to the get in, get out.
Yep.
Those are gambling on moments in time, and investing should never be about gambling on a moment in time. Investing should always be a disciplined process over time. That doesn't mean you don't have opportunities at times, and we've been recommending maybe more than your typical sort of calendar-based rebalancing. Rebalancing maybe should be driven by volatility in asset classes and letting your portfolio tell you when it's time to do something, that you stay in gear, you're trimming into strength, you're adding into weakness, and not making that rebalancing decision on a calendar basis. Use the kind of swings we're seeing in the market opportunistically. So that's the message we've been imparting. We would never say get out now in advance of the election and get back in. That's gambling on two moments in time, which no one can be successful doing. And I think the best investors long term, the most well-known investors long term, are not typically gambling with all their money at moments in time. It is a disciplined process over time. It's exactly what you guys employ with the quads. And the election, we're too binary in thinking about this. I think it's human nature to say, well, if X happens, then Y is going to happen. Even the factors that are more highly correlated to stock market performance don't work perfectly, where if X happens, Y happens in terms of the market. And it's certainly not the case with the election.
Yeah, Diego Parilla did a great job with this yesterday. The guy's up like 35% this year net, which, as you know, is a pretty good number for a hedge fund. And he said, you got to focus on the asymmetry of the payouts, based on where the market just priced those payouts, instead of the asymmetry of your convictions. Your convictions, if they're political, emotional, visceral, hodler, whatever you want to be, I mean, that's an island I don't want to be on. I've tried that island, by the way, and I might as well just go there and drink beer, because it's not the place to help people manage their wealth. I mean, that's bananas.
And it's indirectly tied to what I often point out, which is when we talk about risk tolerance, there is often a huge difference between financial risk tolerance and emotional risk tolerance, and understanding the chasm between the two, which can sometimes be wide depending on who you are as an investor, I think is essential to understanding maybe the mistakes you would be inclined to make throughout the course of a cycle.
Yeah, that by the way, there are plenty of behavioral studies that go back, and by the way, women do much better, I shouldn't say much better, but on average better than men with that factor. Emotional decision making, or selling low and chasing high. Like, you just don't want to do that. You just want to do that to your family, to yourself. If you want to do it, you're definitely not going to run money at a high level. Right. I think if somebody was able to talk you out of your day job, that you'd be an awesome, like, the next greatest hedge fund manager, because you just you can't phase you really. You're just you're dispassionate there.
Wait till the camera goes off. That's when I'm pulling my hair out. But Keith, we probably talked about this before, but my favorite kind of line from a lifelong success story in investing is the late great Sir John Templeton, and it's his very, very famous quote of bull markets are born on pessimism, they grow on skepticism, they mature on optimism, they die on euphoria. What I like about that is he was basically discussing a full market cycle, but the terms he used had nothing to do with fundamentals or earnings or PE ratios. It was all about emotion. And I really think, particularly at extreme inflection points, that's the thing you have to try to understand most. And that's what I learned from my first boss and mentor, Marty Zweig, was the behavioral side of this, which I think is just crucial to understanding how the market works.
Yeah, and I think, and just to wrap up here, we're out of time. I mean, we're at, both bullishly and bearishly, politically or not, we're at like a very emotional time. That's what the VIX curve is telling you.
Sure are.
So it's a very difficult time to say I'm all in or all out, and you wouldn't do that anyway. So I mean, it's just, it's really, it's a
right.
it's a great way to end what was a great conversation, because I really do think that you've learned from, I think we've all learned from, we stand on the shoulders of these giants, and you either choose to learn these lessons and build upon them, or you don't. And you know, Templeton and Zweig, are you kidding me? That's awesome. So thanks for bringing that back to life.
Thank you. Thank you.
She's Liz Ann Sonders. She crushes it all the time. On Twitter, too. She's a very consistent, disciplined, my type of gal. We'll be back here in a second we're going to do a combo between Josh Crum and Stefan Weiler. Thanks.